Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Alimentation Couche-Tard stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. Alimentation Couche-Tard is a Canadian operator of convenience stores. The company has 15,000 stores across Canada, the US, Mexico, Ireland, Norway, Sweden, Denmark, Estonia, Latvia, Lithuania, Poland, Russia, Japan, China, and Indonesia. The company operates its corporate stores mainly under the Couche-Tard, Circle K, and On the Run brands, but also under the affiliated brands Dairy Mart, Daisy Mart, and Winks. The founder opened the first convenience store in 1980 in Quebec. Let's get started with the model. This is a large cap company, 43 billion market cap. They're trading at $38.40 a share, and they have 1.1 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has positive and growing free cash flow each year. Net income is a profit and loss on the income statement. It's revenue minus expenses. And they also have positive and growing net income each year. Revenue is a sales, and that peaked in 2019 at $76 billion, but it's been dropping ever since. This is the company's income statement. And these numbers are in US dollars. My Excel spreadsheet is in Canadian dollars because we're looking at the ticker that trades on the Toronto Stock Exchange. So I converted everything from US dollars to Canadian dollars. So we're looking at US dollars right now. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And then the difference is the gross profit. And they did have their highest gross profit in the trailing 12 months at $10 billion, even though they had lower revenue. So that's a good sign. They're becoming much more efficient. Below that is operating expenses, and below that is operating income. So they generated the most income in the trailing 12 months, $3.6 billion. The company has a good amount of debt, so they had $303 million of interest payments on their debt. And then there's other income and expenses, which are usually impairments or investments. And then you have taxes. And then the bottom line of the income statement is the net income. And that seems to be growing each year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company makes on its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. If a company wants to buy another convenience store, that would go in CapEx. Operating cash flow minus CapEx gives you your free cash flow, and that was highest in the trailing 12 months at $2.9 billion. Free cash flow is the money that a company can use to grow its business, to pay down debt, to buy back stock, or to pay a dividend. The company does pay a small dividend, but another way to reward shareholders is to buy back stock. They bought back $193 million in 2018, $470 million in 2020, and $298 million in the trailing 12 months. The company issued $5.1 billion of debt in 2018 and paid off $1.4 billion. But in 2019, they paid down more debt than they issued. In 2020, they issued a lot more debt than they paid off. But in the trailing 12 months, it looks like they're trying to shed their debt. They paid down $3 billion. They didn't issue any. The most important part of any business is their operating cash flow, and this company has lots of operating cash flow, and it's growing a lot from $2.2 billion to $4.2 billion. And the way you calculate operating cash flow, you take net income, and then you have to add or subtract the non-cash items on the income statement. They pass through a $1.3 billion depreciation expense, so we have to add that back on the statement of cash flows, but that dollar amount brought down their net income. Then there's some other smaller non-cash items. So even though they had $2.8 billion of profit, they actually generated $4.2 billion of cash flow because net income is accounting profit and loss. It's not actual cash. Let's look at a capital structure. $12.9 billion of equity, $13.3 billion of debt. So they have 49% equity, 51% debt, but they have $8.6 billion of net debt. So they could pay off a big chunk of their debt with the cash on their balance sheet. And their WACC is 7.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $91 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $81 billion. We divide that by 1.1 billion shares. And we get a calculated stock price of $73. They're trading at $38, so they're trading at a 47% discount. It's a buy according to the model. Simply Wall Street is at $61, so they're also saying the stock is undervalued. The stock has done pretty well the past few years. It's been climbing a lot. It's been fairly steady the past few months. It did drop a little the past couple of weeks. The stock price did peak in the mid-40s, but it still seems like a really great value according to my model and according to Simply Wall Street. The company was planning on buying Carrefour, the French retail giant, but that did not go through. That's a big reason why the stock price declined the past few weeks. The company does raise its dividend each year, but it does pay a pretty small dividend, 0.77%, and they pay out 9% of their net income and 9% of their free cash flow. This company has a pretty low beta, 0.84, so the stock moves less than a market. And the stock has gone down 15% in the past 52 weeks, much worse than the S&P 500, which went up 13.5%. The 52-week low was 30, the high was 47. The stock is trading below its 50-day and 200-day moving average, so it seems to be on a downtrend. When the 200-day moving average crosses above the 50-day moving average, that's called a death cross. That's a bearish signal. The company had a really high trading volume the past 10 days, averaging 10 million shares per day. 43% of their shares are held by institutions, and it has a really low short percentage, only 51 basis points. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $34,400 today. If you did not reinvest the dividends, you'd have $35,000 today. So if you invested $10,000 into this company in January 2011, it looks like it doesn't matter where you sold, you could have made a profit. The biggest shareholder owns 10.5% of the stock. Then the next shareholder owns a little over 5%. Then a Quebec company owns 4.3%. Then FMR, then RBC. Let's look at the financial ratios. The average PE in the market's 11.2, the median is 14.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have a really good PE at 12.1, so investors are paying $12 for $1 of earnings. Price to sales is stock price over sales per share. They're at 0.7, also another good ratio. Price to book is stock price over book value per share. They're at 3.3, between the median and average. And the way you calculate book value per share is equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $13 billion of equity, but $4 billion of tangible equity because they have $6 billion of intangible assets on their balance sheet, $5 billion of goodwill, and $500 million of other. Interest coverage ratio is EBIT over interest expense. They're at 14.5, so they can easily cover their interest payments. ROE is net income over equity. They're at 28%. They have a great ROE. Current ratio is current assets over current liabilities. They have a great current ratio. Their current assets are $3.7 billion of cash, $1.4 billion of receivables, and $1.2 billion of inventory. The company seems to be well capitalized. They had $3.7 billion of free cash flow, and they have $3.4 billion of working capital. Working capital is current assets minus current liabilities, and they have a pretty small dividend payment, only $330 million. The best way to look at ratios to compare them to similar companies, I've done videos on Kroger, Loblaw, Metro, and Weiss, all in the same industry as ATD. And if ATD has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in PE at 12.1. They have a great price to sales and price to book, but it's a little worse than average. They have the highest current ratio of the companies. They're doing really good in ROE at 28%. They're a little higher in debt than average. They're the biggest company of this group at 43 billion market cap. All these numbers are converted to Canadian dollars. And they do pay a small dividend, the smallest in the industry at 0.77%. So to summarize, I do have them trading at a 47% discount, but this company is still operating at really strong free cash flows and strong net income. And companies like this are really doing well during coronavirus because people are flocking to their businesses because not many people are going out to dinner these days. Also, the company has really good ratios. The only concern is their revenue is going down, but I expect that to improve in the next couple of years. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.